In mid-June 2020, a private jet waited on the tarmac at a small airfield south of Vienna. No press, no police, no visible security detail. The passenger was Jan Marsalek, Chief Operating Officer of Wirecard. This is case number 4, the Wirecard ghost. Hours earlier, he told colleagues he was flying to Manila to resolve a €1.9 billion discrepancy. As the jet accelerated down the runway, nothing appeared unusual. But instead of turning east toward Southeast Asia, it banked north. Within minutes, it crossed into Belarusian airspace. The cash on Wirecard's balance sheet had never existed, and the executive responsible for the company's most opaque operations was already gone. To understand how Wirecard disappeared, we have to start with why it was allowed to exist. In the late 1990s, the internet expanded faster than regulation. E-commerce grew across jurisdictions with conflicting rules, creating entire categories of online business that were legal and profitable, but operationally inconvenient for banks. Gambling platforms, adult content sites, and high chargeback digital services generated massive revenue, but also fraud, refunds, and regulatory headaches. For traditional banks, these merchants were a nuisance. Banks struggled to manage risk across borders, with fraudulent transactions, uncollectible payments, and constant disputes creating headaches that the regulators barely noticed, leaving a vacuum for a company willing to take those risks head-on. Wirecard stepped into that gap. It offered a simple, unglamorous service others avoided, acting as the plumbing for the internet's gray zones: credit card acceptance, currency conversion, cross-border settlement. Higher risk meant higher margins. Every inconvenient transaction generated a premium fee. The model was straightforward, and at first it worked. As online commerce scaled globally, Wirecard scaled with it, moving from the fringes of the web to the center of the financial map. By the mid-2000s, it was no longer a shadow player. Through a reverse takeover, a shortcut to the stock market that bypasses the intense scrutiny of a normal IPO, it entered public markets. But to achieve true scale, it needed a shield, a German banking license. With that move, Wirecard transformed from a high-risk processor into a regulated institution under German supervision. To investors, the story clicked. A technology-driven fintech with global reach, anchored by German oversight. Growth paired with credibility, innovation paired with trust. By 2018, Wirecard replaced Commerzbank in the DAX, Germany's equivalent of the S&P 500. Revenues soared, profits climbed, audits were signed, the system appeared flawless. What almost no one noticed was that the most profitable activity happened far beyond the reach of regulators, in places as invisible as they were lucrative. In a world where a German banking license could make any operation appear legitimate, and the blur of international borders made oversight nearly impossible, Wirecard thrived in the gaps, exploiting every time zone, regulation, and legal gray area that most institutions never pause to consider. Inside Europe, Wirecard was ordinary, verifiable, but the profits driving its stock price came from the architecture of distance. In regions where Wirecard lacked licenses, it relied on third-party acquirers, outside partners who processed payments on Wirecard's behalf in exchange for a cut. Wirecard's share was supposedly held in escrow accounts, temporary holding pens managed by a third party, meant to keep the money safe until it's transferred. On paper, it was a masterstroke of global scaling. In reality, it was a blind spot. Because the funds sat abroad, auditors didn't inspect the banks. They inspected confirmation letters. The system didn't verify the asset. It verified a piece of paper saying the asset existed. These documents were often nothing more than sophisticated forgeries on fake letterheads, designed to satisfy a checklist rather than prove reality. The most profitable parts of the business existed only at a distance: remote, complex, invisible. Everyone assumed someone else had checked the vault. In reality, they were just checking the mail. Even terms like escrow or third-party acquirer were treated as routine in finance. But here they became instruments of illusion, placeholders that existed only in spreadsheets, invisible to auditors and regulators alike. The first crack didn't come from a regulator. It came from the Financial Times. Reporter Dan McCrum wasn't just hunting missing money. He was looking for signs of life: offices, employees, Infrastructure. What he found was a ghost town. Third-party partners, supposedly processing hundreds of millions of euros, were operating out of residential apartments and empty storefronts in Manila. The question shifted. Not where is the cash, but what business is actually generating it? Wirecard responded with total war. They hired private investigators, surveilled reporters, and filed lawsuits. They framed the investigation as market manipulation. And Germany's financial watchdog, BaFin, fell for it. They didn't investigate Wirecard. They investigated the journalists. They even banned short selling, the practice of betting that a stock's price will fall, effectively silencing the market's critics to protect a national champion. The system stopped testing reality and started protecting the narrative. In June 2020, the narrative collapsed. During the annual audit, Ernst & Young finally bypassed the intermediaries and contacted the Philippine banks, BDO and BPI, directly. The response was a death blow. Wirecard was not a client. The accounts didn't exist. The confirmation letters were forgeries. The money hadn't been stolen. It had never been deposited. It was a digital placeholder used to inflate a failing business. Within days, the stock plummeted 99%. CEO Marcus Braun resigned and was arrested. Wirecard filed for insolvency. The national champion vanished, taking billions in shareholder value and pensioner savings with it. And Jan Marsalek? He was already gone. As investigators traced Marsalek's trail, the story shifted from accounting to espionage. Encrypted phones, multiple passports, alleged ties to Russian intelligence. The same infrastructure built to move money across borders had created blind corridors, pathways beyond oversight. A system optimized for scale had become optimized for invisibility. Auditors trusted documents, regulators trusted audits, investors trusted regulators. Each layer assumed the one beneath it was solid. By the time someone checked the foundation, there was nothing there. Wirecard didn't fail because no one was watching. It failed because everyone was watching the wrong thing. In global finance, distance creates efficiency, but it also creates blind spots. When institutions accept documentation instead of verification, trust becomes an asset detached from reality. And like any asset that is never stress tested, its true value is only revealed once it disappears. The story also shows how power can hide in plain sight. The right license, the right narrative, the right authorities, all trusted without question. This was the Cash Files. Case is now closed.